We just got some shocking news, and I've been predicting this for years. The next subprime crisis has now officially started. Ground zero, none other than the great state of Texas. And it says everything to do with the labor market. Let's turn to today's story as U.S. initial jobless claims have jumped to the highest in almost 4 years. And the challenge here is people lose their jobs, they can't pay on their bills, and due to all of the subprime auto loans out there, what we're now faced with is the next biggest crisis since the housing bubble, and it's only going to get worse. And it was very obvious this was likely to happen in Texas because one of the big issues has been there's just low energy prices. And the problem is producers need certain prices to be profitable. And right now that's not happening. And then you have the next issue is the demand. And we've seen that continue to plunge as consumers have pulled back. And that means from a production standpoint, well, rig counts have been declining in a major way. In fact, we can see Permian Basin rig counts peaked back in 2023 and have continued their downward slide. And as they go, so too does the need for workers. And what all this is leading to is you're seeing in the energy sector a squeeze of profit margins, something I've been warning is going to affect companies all over the country. And when you put those three together, well, you can see why the layoffs are beginning. Initial claims rose by 27,000 to 263,000 the week ending September 6th. This is now the highest since October of 2021. And we've heard from experts and the political elites that there was nothing wrong with the labor market because initial claims have remained so low. But I have warned continuously that if continued claims do not come down, that what we're going to do is see a spike in initial claims. And as we see rig counts decline, this is exactly what's happening in Texas. In fact, the numbers were boosted by an outsized increase in Texas, which reported 15,304 surge in claims before adjusting for seasonal factors. Michigan, falling in second place, lost just under 3,000 jobs, while a majority of states all registered declines. So while we're seeing other states bring on jobs, what we're seeing in Texas, and again, this is everything to do with the energy sector. We heard this from ConocoPhillips. We're hearing this from Chevron, mass layoffs in the energy sector, and all this is going to do is lead to a rise in initial claims. It's going to push continued claims higher. But something else that should be rising, that's your trading account. Let's check out this trade. This is our Metre strategy trade. We put this out on the 5th. To all our subscribers, it was on GDXJ. It's now up as of yesterday's close, 7.58%. And my friends, we have changed the game of the way people trade because rather than the one-size-fits-all approach, we have optimized every strategy across a per security basis. Nobody's done this. In fact, I'm going to show you how this compares to the Bravo 9 strategy. Stay tuned to the end of the show, but to jump in on this and right now, grab those links in the description below and use a coupon code for your free 30-day trial. Because U.S. jobless claims have jumped to the highest in nearly 4 years. And again, this is a warning sign for an economy that everybody said was in good shape. And then we got the non-farm payroll report, which indicated that over the last 2 years, we haven't seen much growth. In fact, because we need to see around 150,000 jobs created a month just to sustain the economy, what we found out is over the last 2 years, the economy has been growing below trend. Now the problem is, due to the fact that demand is plunging and margins are getting squeezed, companies are forced to lay off. But the good news is continuing claims, which is a proxy for the number of people receiving benefits, remained unchanged at 1.94 million. But the problem is, as we see initial claims rise, we know some of these people are going to find work, but that could stack up quickly for those who don't, pushing continued claims over what I believe, if it gets over the 2 million mark, it's going to spiral right out of control. And this is exactly the risk that I've been warning about. Let's take a look at this chart of continued claims in blue against initial claims in red. And what you can clearly see in past cycles is as continued claims rise, what happens, you see initial claims start to follow. Now, since going back to, say, around 2022, we saw initial claims remain, well, historically relatively low as continued claims continued to move higher. Now the problem is, and I've warned about this, at some point either initial claims are going to start to rise or continued claims are going to fall. But due to the profit margin squeeze that companies are going through, and they're trying to defend their stock price by continuing their buybacks, they're being forced to lay people off. And as initial claims push higher, what you're going to see as many of them are not going to be able to re-enter the workforce. That's going to start putting upward pressure on continued claims, and then we're going to spiral right into a recession. And Thursday's figures show a monthly report on employment published on September 5th, which showed the U.S. added just 22,000 jobs. And a lot of people are saying, look, this has to do with uncertainty surrounding the economic policies from the Trump administration that's made employers more hesitant to hire. And I don't think that's really the case at all. I think this is a demand case, because the problem you're seeing here, why is this kicking off the next subprime crisis? Because people are losing their jobs. They can't re-enter the workforce, and that's why we're seeing Texas as the epicenter here due to the energy market, not just for layoffs, but as you're about to see for the next subprime crisis. Because again, it's about incomes. When we talk about the economy, uncertainty is really easily fixed if people are seeing their pay raises go up, if they're seeing more hours. But we're not seeing that, because if the economy was starting to turn around, we would see hours worked jump. And instead, what are we hearing from the energy sector? Mass layoffs. Now let's take a look, because over the past year plus, what have we seen? That hours worked have remained rather stagnant. So again, this isn't about uncertainty, because if demand was moving higher, what you would at least see from employers is they give their existing workforce more hours. They're not doing that. The real issues is going all the way back the last 2 years. The U.S. economy has been slowing. It's been growing below trend, and now we're starting to see the pain and the cracks start to form. As subprime auto lender collapse delivers blow to risky debt market, again, Texas now the epicenter of what could be the next big subprime crisis. And again, you go back to the housing crisis, and what did we see? All this demand for housing, but there weren't enough people, because you saw people buying multiple homes and then buying more homes on leverage and margin. What are we seeing in the subprime auto market? People taking out super risky loans at super high interest rates. They can't afford the vehicles. And as the labor market goes, well, a lot of these cars are going to go back to the banks. The problem is a lot of small lenders do auto loans, and while their parking lots are about to turn into used car dealerships. The sudden collapse of a Texas subprime car lender is sending shockwaves from border town dealerships all the way to the upper echelons of Wall Street, ensnaring giants including JP Morgan Chase and BlackRock, and raising concerns that the pain in the multi-billion-dollar market for bundled auto loans is about to mount. And yes, it is, because it's all about the labor market. And that's why I wanted to talk about this big jump in initial claims hitting its 4-year high, because if this persists, what you're going to see again is more Americans are going to fall behind. They're going to increase the delinquency on their credit cards, their auto loans, and that stress is going to continue to build until you start to see more companies fail. This one being now the first. As a growing number of low-income borrowers have struggled to make their car payments, the bonds backed by these loans, known as asset-backed securities, have begun to show cracks. But again, you think about the problems in the U.S. economy right now. It's not just low-income consumers, because look at these jobs lost in the oil field. They're high-paying jobs. A lot of them are middle-class jobs. So what are you going to see? More stress moving from the lower incomes up to the middle class. We're even seeing some high-income Americans fall behind on credit cards and auto loans. And next thing you know, this whole thing is going to spiral right out of control. But if you're looking for blame, well, maybe you should point it to Wall Street, because there's a twist reminiscent of some of the excess seen during the subprime housing boom in the 2000s. This relentless investor demand also paved the way for what some critics say are lax lending standards and an absence of much needed safeguards. So if you go back to the housing bubble, what happened? Well, there was so much demand for all of these loans that lenders just continued to lower their lending standards to get more buyers. And at some point, as we all have now learned, that there were even ways to get loans, in fact, if you didn't have an income. But Wall Street didn't care. The appetite for this was so big. And now it's all in subprime autos. There's such a big appetite. What you're seeing is a lot of dealerships, particularly in that space, were just giving cars to anybody, even though they knew they couldn't pay. Wall Street didn't care. They just wanted more. Now the problem is, as the labor market unwinds, what you're going to see is these cracks in subprime are going to get wider and wider until it opens up right into the next financial crisis. And while the tricolor bankruptcy may seem isolated and idiosyncratic, one would be remiss not to ask whether or not it's a canary in the coal mine for subprime auto lending. And again, That's why I started the show out talking about the labor market here, because it's all about the labor market. If people don't have jobs, well, they can't pay on their debt, and that's the problem here. Around 1.94 million Americans are stuck on continued claims. They can't find another job, and the labor market isn't creating them. Now, due to the fact that demand is plunging, what you're seeing is a lot of companies are getting squeezed at the margin because they've got to absorb the tariffs. Now, the issue then is, well, when you've cut all your other expenses, you start cutting headcount, and the next thing you know, everything starts to spiral out of control. And that's why I'm saying this is just the beginning of what's to come. Texas, again, being the epicenter of the next crisis. As we take a look at average weekly hours of production and non-supervisory employees in blue against the delinquency rate on credit card loans. And here you can see very clearly, let's go back to 94. That was the year I graduated high school. And what do you see? A little slowdown in the economy as average weekly hours dropped. The delinquency rate went up. You see that repeat going into the dot-com bubble very clearly during the financial crisis. You see it happening going into the pandemic as the global economy is headed into a recession. And then look what happened in late 2021. Well, we saw the same thing. As hours worked began to decline, you see the delinquency rate rise. Everybody started to celebrate when the delinquency rate cooled off a little bit. But now that hours worked aren't turning around and we're seeing more people lose their job, you can expect the delinquency rate to rise. In fact, that we're sitting on a record amount of debt, particularly a lot in the consumer space. And you think about auto loans. You know, looking back to the housing market, it's easy to get rid of that second or third home that you just don't pay on it because you're not using it. But how about automobiles? Well, some families have several of them. And when they get behind on one, they just go get another one. And next thing you know, they're just going to quit paying. You're going to see a lot of repos in this space, and the banks are going to have no answer. They're going to have to wholesale these. They're going to take losses. And again, you think about the bank situation. We just had a liquidity crisis a few years back. What's the problem? The banks don't have the cash. Interest rates are too high. They can't sell off their bonds to get the cash they need. You can see very clearly why interest rates are at some point headed back to zero. It's all because right now in Texas, layoffs in the oil field are pointing right to the next subprime crisis. Yet the downfall of Tricolor shows how even a niche lender can send ripples through Wall Street when business unravels, but that's exactly how financial crises start. It starts small and then it starts to spread, because on the initial impact, nobody really cares. They're going to look at this and say, well, it's isolated Texas, it's a border town dealers, it's because we're sending illegals home, and well, they shouldn't have had car loans anyways. But then what's going to happen is the labor market's going to continue to weaken, and then another one's going to pop up and go bankrupt, and everyone's going to find a reason to dismiss that, and then a third one's going to pop up, and then next thing you know, all of a sudden a bunch of things are going to blow up. And again, it's all stemming back to the fact the economy has been slowing, paychecks relative to inflation haven't been increasing, and the issue then is coming down to the Fed in the next meeting. There's going to be a rate cut, but based on what we just saw in the CPI today, I think two, which many are hoping for, are now off the table. U.S. core CPI rises as expected, keeping the Fed on track for a rate cut. And again, this is part of the reason why consumers are falling behind. This is why we're seeing the delinquency rate rise. There's only so much money, and they've got to buy a certain number of things. Those extra things, like maybe that extra vehicle, well, forget paying on that. Let that loan go. Because the core consumer price index, excluding the often volatile food and energy categories, increased 0.3% from July. When incorporating those components, it rose 0.4%, the most since the start of the year. So again, you think about the economy right now and how workers are really looking at it. They're seeing other people lose their job. They're now seeing claims start to rise. They know there's no other opportunity, and costs of living are still rising. Now, so from the Fed perspective, they're seeing the labor market slow down, but they're going to be worried about inflation. So my prediction is the Fed goes 25 basis points, but sets open the fact that they could be cutting at future meetings. They're going to still be worried about inflation here, but not for long, because several household expenses also picked up, including groceries, gasoline, electricity, and car repairs. So if you think about the things that consumers have to spend money on, well, you may not have to fix your car if you got several of them, because if you don't have a job, well, maybe you don't need to drive it to work, but you do need groceries, you do need gasoline, and you're going to need energy. And particularly after a very hot summer, we saw a lot of electric bills surge. So what's the issue here? think about the discretionary side of the economy. As people have less money and have to focus on their core spending, there's less money to other parts of the economy. You see hours starting to get cut even more. People are going to lose their job. And next thing you know, it could just continues to unwind here. And even so, Fed officials are widely expected to cut interest rates for the first time this year at their meeting next week. After a series of weak employment data, this is now priced in completely by Wall Street. But firm inflation, if sustained, may complicate the path for additional reductions at subsequent meetings, giving me kind of the indication here. You have rising inflation, a slowing labor market. The Fed wants to cut, they're going to cut, but they don't want to go 50. That's my prediction. They're going to come out and say, look, it's a 25 basis point cut. Inflation did go up. We're concerned about that. We can always cut in future meetings. But when you look at the silliness of all this, because really it doesn't make any sense. What we're seeing is a subprime crisis building off the labor market unwinding. But yet in Europe, look at this. ECB keeps interest rates on hold amid traders ruling out more cuts. Now, can you imagine this? That they're not going to cut anymore? But look to Germany today. Look at this headline. As German exporters sound alarm over trade tariffs and weak demand, well, as demand continues to fall, as the U.S. economy unwinds, what you can expect is you better believe the ECB is going to cut right alongside the Fed's going to cut and every major central bank. The problem is none of it's going to work because what we're seeing right now all across the world is companies are continuing to be squeezed at the margin, and this is putting them into a position where they're going into survival mode. The only thing left they can do is cut jobs. As they cut jobs, all this massive amount of debt that's been built up over the last decade plus is going to start coming unwound. We're going to see delinquencies rise. We're going to see defaults rise, and that's likely going to put us right into the next financial crisis. But if we do have a financial crisis, it doesn't mean you can't make money in the markets because we are changing the way people trade. Now, let's take a look at a very popular strategy. In fact, some of you may be using it. It's called the Bravo 9. Now, according to my buddy Jay Bravo, he says it's a one-size-fits-all strategy. It works perfectly in all cases, but my friends, it doesn't work that well at all. Let's take a look at this back test over the last 2 years against the SPY, that's the S&P 500 ETF. Here you can see a 51.5% win rate, 33 trades, and does have around a 7% drawdown and still underperformed a buy and hold strategy. But now let's talk about our meta strategy, because what I did is it's a multi-strategy consensus. We pulled in the Bravo 9, Turtle Trading, 200 cross gold. We pulled in a whole bunch of strategies here, 9 of them, and I optimized every one of them on a per security basis using the latest in AI technology. And we have gone above and beyond here because we're optimizing this for swing trading. We've got a target hold period of 10 days. We're generating a massive amount of signals, and our success rate, well, it's not 55%. It's even better because here you're seeing the optimized parameters against SPY for our meta strategy. Look at this. Total return beating a buy and hold strategy. 69 trades instead of 33, a 66% win rate instead of 51, and same drawdown. We, again, are changing the way people trade, and right now it's included in any of my reports at no additional charge. So for the next 30 days, you can test this out. Now, what should you do? Sign up for either a CTA Timer Pro, and that we trade against machine positioning, or a Momentum Timer Pro if you like to trade against momentum signals. Either way, you get the daily report on both of those, and you get the tradable signals on top of the meta strategy trades. You get my opinion on the best trades. We give you risk control levels. Again, we make this so easy. A full tracking of all open trades and returns, a weekly update, and again, the best part is you don't even have to put a dime out to try this, because all you got to do is use those links in the description below and the coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.